Hello, my name is Patrick Fornan, Head of Corporate Finance at TC Group.
Hello, my name's Paula Carter and I'm an Associate Director of Corporate Finance here at TC Group.
Today we're going to be covering off some topical issues and some considerations for business owners thinking about succession planning. The government announced a basket of measures in the autumn budget, all of which could either now or in the future impact business owners considering succession planning. Just to quickly highlight some of those changes, the first was the increase in the main rate of capital gains tax, increasing that from 20% to 24% with immediate effect. The second was changes to business asset disposal relief. So that was historically entrepreneurs relief. That's been a bit of a political football over recent years, but now the main rate is 1 million of qualifying lifetime gains per individual at 10% tax. That's increasing to 14% in April 2025 and 18% in April 2026. So again, as a consideration for business owners who are thinking about a sale in the near future. Finally, a change from the budget that went under the radar were the changes to business property relief. So this is alongside agricultural relief, will impact business owners thinking about a sale in the future, whereas if they don't think in advance, there's an opportunity for them to be caught by the inheritance tax kind of trap. In summary, we expect the M&A market to remain buoyant following the changes from the budget. However, for those business owners thinking about succession, it is now more critical than ever to start putting plans into action earlier to start crystallising that succession plan. Let's start with trade sales. A trade sale is a sale of one of our clients' businesses to either a corporate purchaser or a private equity or even a private equity-backed corporate purchaser. There are a number of advantages and disadvantages of a trade sale, and I'll cover a couple of the headlines of those in a little bit of detail. A trade sale might increase the amount of consideration due to a seller on a sale. This is in particular in relation to a management buyout or an employee ownership trust variant, for instance, whereas a third-party purchaser may generate savings, synergies, and cross-selling opportunities from acquiring your business. Some of those savings may be passed on through the purchase price. Equally, running a competitive tendering process when marketing a business for sale, particularly to a trade buyer or international trade buyer, can also drive the price upwards. Another advantage is accelerated consideration and also the amount of consideration that may be received on day one. Again, looking at a variant of a sale to management versus a sale to a third party. A third party would usually have cash reserves or be backed by a private equity fund to allow a cheque to be written on day one for the majority of the purchase price. A further advantage would be a handover period. Again, this would be a condition of the sale, but we'll be looking for a corporate purchaser with a robust management team and or a management team and other operations in the UK or overseas to allow the owners, if they wished, and if it aligned with the objectives of both parties, to work for 6 to 9 months, for instance, or even leave with immediate effect to receive their consideration and not carry on in the business. Finally, one advantage of a trade sale is that capital gains tax would apply, assuming it's a sale of assets or shares. The main rate of capital gains tax is 24%, and again, that's probably lower than we expected it to be following the autumn budget, but again, it's a wider consideration that capital gains tax does still remain lower than income tax or tax chargeable to dividend income. Looking at some of the disadvantages. The first would be due diligence. So in the instance of a third-party sale, a buyer would be engaging with third-party lawyers, financial advisors, and commercial teams to carry out a thorough review of your business. Ensuring that you're organised and getting prepared in advance for that is critical, but again, it can be quite a torturous process, and quite often owners aren't aware of that from the outset. A second risk is transactional risk in relation to confidentiality. Again, a sale isn't done until the sale's done. Therefore, during the negotiations, the due diligence process and the legal processes, there may be a risk that employee details, customer details, or even some of the intellectual property of your business gets leaked or gets shared with a third-party purchaser. Therefore, it's crucial that we're cautious in terms of what we're redacting, what we're sharing with a third-party buyer. But again, we also ensure that whilst NDAs will be in place, and we get those in place from the outset, there's always an element of risk. Linked to that, there's the disadvantage of the owners taking the eye off the ball during the process. And again, we always recommend that business as usual remains, but we're mindful that this is it can be quite a cumbersome transaction particularly, and it can be time consuming for owners. So making sure the business continues to gain momentum and continue to operate successfully is critical. Finally, one of the disadvantages could be the risk of not receiving any deferred consideration or earn out or performance related consideration. So again, it's fairly common in a third party sale for a buyer to pay a percentage of the consideration on day one and a small percentage that you may receive within 6, 9, 12 months or even longer. It's also popular for owners to look at earnouts, so looking at the future performance and profitability of the business and linking some of the consideration to that. Whilst you, the sellers, will have lost control on the date of the sale potentially, there is a risk that the earnout or the deferred consideration will not be payable. Therefore, ensuring the legal processes and the financial agreement of how those payments are calculated and assessed is key. In relation to how we support our clients with trade sales, ideally, we like to be engaged 1 to 2 years in advance to prepare the financial records and make sure the business is geared up for a sale. However, a lot of our clients are approached by third-party buyers, and again, we're equally happy to get involved at that stage to negotiate and project manage the transaction. We do market businesses for sale, both in the UK and internationally. We've got a number of international networks to find buyers overseas, which again has helped some of our clients achieve, let's say, valuations at the topper or exceeding the topper end of valuations, particularly with some of the fluctuations in exchange rates in the last 12 months. In summary, a trade sale can be a fantastic opportunity for business owners looking to exit. You may receive an increased price and you may receive more money on day one. However, it's not without its risks. Therefore, we always ensure with our clients that a trade sale is the right route for the owner, for the business, the employees and the wider stakeholders before embarking on the project.
Another option is a management buyout. So let's now consider a management buyout. A management buyout is what it says on the tin. It's you as a business owner selling your business to the management team. What are the key considerations of a management buyout? Well, as a seller has greater control over the process, selling to the management team than if you're selling to a third-party trade buyer or private equity, for example. You're much in a stronger position to present an opportunity to the management team, and there is less negotiation typically associated with this type of sale process. As such, there tends to be higher completion rates as well, which is a great advantage of this type of transaction than selling to a third party who potentially knows very little about your business. The due diligence process is also an area which it's less intrusive selling to the management team, as the team in place will already be familiar with, for example, terms of trade with customers and suppliers, and also employment contracts as well. So there'll be less due diligence that the management team will want to actually undertake, as they'll already be familiar with the business. There's also reduced risk of a confidentiality breach with this type of transaction. Management are in the business, they're obviously aware of key sensitivities around commercials that are in place, and therefore there's less likely that information will be passed outside of the company than, for example, when selling to trade, and they'll be looking to get on under the bonnet of all areas of your business, and there is a higher risk of a confidentiality breach with that particular type of buyer. Also, for sellers, the warranties that they'll be typically providing to the management team will be light touch, will be much less onerous than we're selling to a trade buyer. So what are the potential drawbacks? One thing to think about is typically there is a lower valuation selling to the management team with extended payment terms. Management may not have access to significant funds on completion to enable a larger payment on completion than, for example, a trade buyer or private equity may be able to make. And payments to you will be made out of the profits of the company over a period of time, unless there is bank funding available to accelerate any payment to you on completion. There's also a risk to the relationship with management during the process. If negotiations do become protracted, then it's just one thing to bear in mind, that having a good relationship in place and maintaining that throughout the process is one thing to bear in mind. So what does it mean for you as a business owner? It means that hopefully you have access to a strong management team in place, and you have an internal buyer, which means that you are not having to embark on a process of looking external to your company to establish whether there is a good fit between a buyer and yourselves, because you will already know that. You will also know what business skills they have and are they at the right level, and will have much greater control to coach and develop your management team so that when you ultimately exit your business, you know it is left in safe hands with a management team that has a deep understanding of your business, of the financials, of customers and suppliers, and also culturally your workforce to know that they will equally be looked after. What does it mean for the management team themselves? They may well be ambitious and want to hold that share certificate. So a management buyout is an ideal transaction to enable them to hold equity in the company and be incentivized to grow the company going forward under their direction. For you as a business owner, you may require your management team to inject some funds into the company on completion so that you know and understand they have some skin in the game as well. So the management team, there will be an element of personal risk, but that personal risk is something that you as a business owner probably took on yourselves as well when you took over ownership of that company, or indeed set it up. And therefore, if you've got deferred consideration at play, you will want to understand that growing the company and being profitable, your goals are very much aligned with the management team, and they will want to make sure that the company is successful under their ownership as well. The management team, however, may require your continued support post-completion to enable them to step up and take ownership of the company and drive it forward at a strategic level. So this type of transaction is highly flexible and can facilitate both of your aims, both the aims of the management team and your own. An option skyrocketing in popularity is an employee ownership trust. So let's now consider a sale to an employee ownership trust. So what does this sale look like? It's a sale of the shares of the company or trading group to a trust that's set up for the collective benefit of all the employees. This is a form of ownership that has been around for about 10 years now. And the primary driver was to incentivize owners to sell their businesses to a trust, which is about engaging employees and driving productivity in the economy over the longer term. So there are certain conditions that must be met in order to qualify as an employee ownership trust. The first is that the investment must be made in a trading company or group, that the trust must own a majority stake, which is 51% or more, in that company or group, and employees must be capable of benefiting on equal terms. So what are the benefits of selling to an employee ownership trust? For the sellers, they're able to benefit from a tax-free sale, provided certain conditions are met, such as the company must be a trading company or group, and the trust must post-sale have control. Another condition is that employees must be capable of benefiting on equal terms. So for employees, they're able to benefit from tax-free bonuses of up to £3,600 per annum. Other benefits include greater engagement and increased productivity by the workforce over the longer term. This type of ownership structure has been particularly popular with people-led businesses. So as a team, we've advised on many EOT transactions, and we've seen them very popular indeed. working really well for people-led businesses. So within the construction sector, for example, where you have planning agencies, where you have consultancy businesses and architectural firms, we've seen quite a high take-up within that sector of this type of business ownership. So one example that we've got is where we advised a property and energy consultancy business, a 12 million turnover company. We advised the owners on achieving a tax-efficient sale to an employee ownership trust, and also in addition to that, advising on additional management incentives to reward more senior people within the company as well. So what did that look like? We first of all advised on the valuation and supported the company achieve tax clearance. So note that in the last budget, the requirement for tax clearance on EOT transactions has been removed, but there now is a requirement for the actual trustees themselves to oversee the valuation to make sure it's not above market rate. So there's still quite a key piece of work that is required, even with the removal of tax clearance. In addition to that, we also helped by presenting to management and employees to understand what employee ownership means for them. And we also, as part of the transaction, liaised with the lawyers, so had input into the legal documents and project managed that transaction from start through to completion.
Quite often, the sale of a business for business owners is the largest commercial transaction that occurs. Therefore, you want to make sure that when you carry out a transaction, it's done at the right time, for the right price, and with the right advisors. And we cannot echo enough that planning early for succession is now more critical than ever, particularly with the changes around business asset disposal relief, business property relief, and with main rate of capital gain tax increasing, there's lots of other factors to consider. But fundamentally, making sure you make the right decision at the right time is key.
So with regards to early planning, we recommend beginning with an options report. What does an options report look like? It begins with a valuation of your business and considers that valuation in the context of different succession routes. So as we've looked at today, a trade sale, a management buyout, and also a sale to an employee ownership trust. It also looks at the financial and commercial and transactional risks and advantages around each of those different deal structures to enable you to see which option is really the right one for you and your business and your legacy.
If you would like to discuss your future succession plans in more detail, please do not hesitate to get in touch for a free consultation.
And thank you everyone for listening.